Welcome, everyone. Today, we are diving straight into, well, probably the biggest financial headline imaginable right now.
You mean gold?
Exactly. The massive, almost unbelievable move in the price of gold. It's hit $4,000 an ounce. First time ever.
Wow. Yeah. And if you've been holding gold, stacking bars or coins, maybe holding mining stocks,
Oh, yeah.
your first feeling is probably, finally,
Right.
like euphoria, a
Yeah.
real sense of validation after maybe years of waiting.
A long and you feel well-deserved victory lap.
That's the feeling. But the analysis we're looking at today really challenges that. It poses the tough question.
Which is?
Is this really a victory? Or is this spectacular rally actually, well, a warning sign? The argument is that this kind of extreme price action, it doesn't happen in a vacuum. It's signaling something, something bad.
Something pretty bad coming down the pipeline, yeah.
Yeah.
That's the core idea we need to unpack.
And it's the speed, right? The sheer velocity of this move is what grabs you. We're talking about gold nearly doubling.
Almost 100% up. Since its last breakout, which wasn't that long ago, wasn't that like February 2024, just earlier this year?
That's right. Moves like this fast, they usually anticipate really extreme consequences. It's not just a gentle drift upwards.
So the market isn't just pricing in, I don't know, a bit more inflation or some geopolitical tension we already know about.
Exactly. The implication is that the market's anticipating something different, or maybe just much more extreme than even what we saw back in, say, 2020 during that crisis atmosphere.
Okay, so it's signaling maybe a structural alarm about the whole global financial setup.
That's the argument, a fundamental shift in the architecture. So we need to approach gold differently here, not just as, a safe haven people run to when they're scared.
But more like a predictor.
Yeah, a sophisticated anticipatory indicator, like a canary in the coal mine, but for policy, telling us what global policymakers are going to be forced to do next.
Or maybe what the inevitable result of their past actions is finally going to be.
Precisely. So let's dig into that historical role first. How does gold actually anticipate things?
Okay, so to really get why $4,000 gold might be this massive warning sign, we need to accept this core idea. Gold leads, it doesn't just follow.
Right. It anticipates the consequences of monetary policy, often months, sometimes even years, before you see those consequences pop up in, the standard economic numbers like inflation or GDP.
So let's make the case. The period from, say, 2014 to 2020 seems like a perfect example.
It really is.
Yeah.
Think back to that time. For a long stretch there, gold was just sideways.
Consolidating, yeah. Between 2014 and mid-2019, it felt like it was stuck in a range. What was it, like $1,100 on the low end?
Yeah, maybe up to $1,300 or $1,400 on the high end.
Yeah.
Pretty narrow band, relatively stable.
It was just bouncing around in there for years.
And that consolidation, that was basically gold absorbing the energy or lack thereof from the post-2008 slow growth, low rate world. But the key bit for us today is when that quiet period ended.
Okay, when did it break?
Gold broke out of that range, started its big run around halfway through 2019, middle of the year.
And it wasn't a small move. It went up, what, 50%? Pretty fast.
50% within a single year. It peaked in August 2020. But here's the kicker, the really crucial detail for you listening.
The timing.
The timing. That big move started in June 2019.
June 2019. Okay, why is that date so important? Let's connect the dots.
Because it was before the stuff that people remember as the trigger. Remember the repo market crisis, when overnight lending rates just exploded?
Oh, yeah, September 2019. That felt like the first real crack appearing in the system back then.
Exactly. But gold had already been moving up strongly for 3 months before that repo stress became obvious news.
Oh, okay.
And even more critically, the huge waves of QE, the massive money printing that really defined 2020.
The pandemic response money.
Right. That didn't really get going until months after gold had already started its climb.
So gold wasn't reacting to the repo crisis hitting the news or the pandemic lockdowns forcing the printing presses on.
No. It was anticipating the need for those liquidity injections. It sensed the pressure building, the inevitability of monetary expansion, months before the central banks actually had to hit the big red button.
It anticipated the consequence of the printing, not just reacting to the event itself.
That's the key insight. And this lead time, this predictive power, it holds up even better if we look at something like inflation, consumer prices.
Okay, so gold peaks in August 2020. Where was inflation then? The CPI numbers.
Well, the really high inflation that everyone remembers from 2021, 2022, 2023, that hadn't even started yet. Not even close.
Right. I remember looking this up. The CPI, the official inflation measure, it didn't get back above, say, 2.5% until March 2021.
March 2021. That's a full 7 months after gold had already done its huge run-up and was starting to level off to top out.
And the actual peak of that inflation wave, when did that happen?
That wasn't until June 2022, almost 2 years after gold peaked.
Wow. So gold wasn't reacting to high prices in the shops. It was anticipating the policies that would cause those high prices way down the line.
Absolutely.
Yeah.
It anticipates the monetary conditions. Once that future inflationary policy is kind of known, priced in, discounted by the market, gold starts to cool off. It did its job.
Okay, that's compelling comparing it to inflation, but what about other assets, like the stock market? Did gold and stocks move together? Sometimes people think easy money lifts all boats at the same time.
You might think so, but no, not really in that sequence. Back in August 2020, when gold hit its peak price,
Yeah.
the S&P 500 index had only just and barely managed to claw its way back to the previous all-time high it set before the initial COVID crash in early 2020.
So gold had already finished its huge stellar run while the stock market was basically just getting back to even.
Exactly. And here's where it gets really interesting for understanding market dynamics.
Yeah.
Gold topped out and started consolidating.
And then,
Then the S&P 500 took off on its final massive sort of euphoric rally, the one that eventually peaked way later at the end of 2021.
so gold called the policy consequence the easy money, and it signaled the end of its own big monetary-driven move before the final big blow-off top in regular stocks even finished.
That's precisely the sequence. Gold not only anticipates the policy, it often anticipates the end of the cycle for other assets that benefit from that policy later on.
Okay, so this historical pattern gives us a lens, a way to interpret today's $4,000 price.
It's our roadmap. Gold signals what policymakers will basically have to do because of the corner they're in, or what the systemic results of their past actions and current constraints are going to be.
And it does this long before you read about it in the CPI report or see the stock market peak reported on the news.
Right, which makes this $4,000 number not just some historical footnote. It's a live, flashing, very extreme warning about the systemic policy response that the market believes is now essentially locked in.
Okay, so if gold is this powerful predictor, what is it predicting now at $4,000? The easy answer, the one you hear thrown around a lot when gold spikes.
Is the flight to safety.
Yeah.
Fear, panic.
Exactly. Investors get scared, they dump risky stuff, they buy gold. Classic story.
When we actually look at the data, the broader market picture right now, that narrative just doesn't hold water. It completely falls apart, actually.
How so? What's the evidence against it?
Well, think about what a traditional flight to safety actually looks like. Investors sell risky assets, right? They dump stocks, especially the high-growth tech stuff. They sell high-yield junk bonds, maybe emerging market assets, crypto.
They get out of anything perceived as speculative or dangerous.
And they move that money into things they think are safe. Historically, what are the two main safe havens?
Physical gold and U.S. government bonds, U.S. treasuries.
Exactly. Gold and treasuries. That's the classic fear trade. Sell risk, buy safety.
But is that what's happening today?
Well, no, not even close. We're seeing almost everything go up at the same time. It's bizarre.
Right. Bitcoin is at or near all-time highs. The S&P 500, the Dow, even the small cap Russell 2000, all hitting records or near records. U.S. home prices, still incredibly high. So risk assets are absolutely not being dumped. If people were genuinely fleeing risk in that traditional sense, we'd see massive selling pressure on stocks and crypto, not new highs everywhere.
That's point number one against the simple fear story. Fear usually means making a choice, risk or safety. Today, the market seems to be choosing, well, both in a weird way. Or maybe it's redefining safety.
It feels like people are buying assets, any assets, rather than choosing between risky and safe ones. But what about the other pillar of safety? Treasuries.
Ah, yes. U.S. Treasuries. If this was a textbook flight to safety, what should be happening to them?
Capital should be flooding in. People desperate for safety would buy treasuries, pushing the price up.
And pushing the yield down.
Wow.
They'd accept a lower return just for the security of knowing the U.S. government theoretically guarantees repayment.
Okay, so what are treasury yields doing while gold is hitting $4,000?
This is critical. The 10-year Treasury yield is actually up. It's staying elevated. Sometimes it's even spiking higher.
Even after the Fed might signal policy shifts, like rate cuts, that you'd think would push long-term yields down.
Even then, yields are stubbornly high. And remember what a higher yield means.
It means the price of the bond is falling. People are selling treasuries or demanding a much higher interest rate to hold them because they perceive more risk.
Precisely. Selling pressure, not buying pressure. If there was a true flight to safety, buyers would be snapping up treasuries, driving those yields down towards zero, maybe even negative in real terms.
So the fact that the traditional safe haven asset, U.S. Treasuries, is being sold off at the exact same time the other safe haven asset, gold, is rocketing higher, that's a major disconnect.
It's the ultimate decoupling. It tells you this isn't your grandfather's flight to safety. Something else is driving this.
Okay, help me process this then. Gold is soaring, which usually signals fear. But stocks and crypto are also soaring, which signals risk-on appetite. And the ultimate safe asset, treasuries, is being sold. What kind of fear is this? It feels weird.
Conflicted. It's because the fear isn't about typical market risk anymore. It's not investors simply getting nervous about stock valuations and moving to bonds.
So what's the fear of?
The fear is structural. It's a profound, growing distrust in the fundamental pillars of the financial system itself, specifically fiat currency, the dollar, the euro, the yen, and the long-term solvency of the governments issuing that currency and that debt.
So the market is signaling that the system itself feels unsound, making the old risk-on, risk-off playbook kind of obsolete.
That's exactly it. Money isn't just fleeing risk in the traditional sense. It feels like it's fleeing fiat currency. It's fleeing the eroding value of government promises.
And seeking shelter in anything that feels real or scarce.
Anything. Stocks represent ownership in real companies. Real estate is tangible. Commodities are raw materials. Bitcoin is digitally scarce. And gold. Well, gold is the ultimate historic, non-fiat, non-sovereign store of value.
So it's a rush into assets to escape currency devaluation and potential government default, rather than a simple rotation between asset classes based on economic forecasts.
Precisely. The signal from gold isn't just, I'm scared of a recession. It's, I'm scared the money itself isn't sound and the government backing it is over-indebted. When money leaves treasuries while gold goes parabolic, that signals deep distrust in the core of the system. It's a systemic realignment.
Okay, if this isn't just retail investors panicking, but a deeper structural distrust,
Mm-hmm.
who are the big players driving this? Who's validating this $4,000 alarm bell?
Well, this is where it gets really fascinating. The analysis points squarely at the biggest, most informed, and frankly, most systemically important buyers on the planet.
Ooh.
The monetary policymakers themselves. Central banks.
Central banks are the biggest buyers of gold right now.
They have been huge, consistent buyers for years now. And it's not just one or two, it's a broad trend, especially outside the core Western G7 nations. This purchasing reflects a massive, almost tectonic shift in how countries are managing their foreign reserves.
Wow. Okay, give us the headline statistic here. How big is this shift away from, say, the U.S. dollar or U.S. treasuries in their reserves?
Get this. For the first time in decades, possibly since before the Bretton Woods system ended, foreign central banks, as a group, now hold more gold as a percentage of their total foreign reserves than they hold in U.S. treasuries.
Wait, say that again. More gold than U.S. treasuries in their official reserves.
As a percentage of total reserves, yes. That is an absolutely monumental shift. It's a quiet financial revolution happening in plain sight.
That's incredible, considering the U.S. dollar and treasuries have been the dominant reserve assets for, what, 50, 70 years?
Exactly. And who's doing the buying? It's countries like China, Russia, India, Turkey, many of the BRICS nations and others outside that traditional U.S.-Europe sphere of influence. They are systematically, year after year, adding physical gold to their vaults.
And why? Is it just diversification? Or something more?
Diversification is part of it, sure. But the analysis suggests it's much deeper. It's a hedge against the financial policies and the long-term debt sustainability of the major Western economies, particularly the U.S.
They're hedging against the dollar system itself.
That seems to be the critical takeaway. The very institutions that manage global currency stability are actively choosing non-sovereign gold over what was always considered the bedrock safe asset, U.S. government debt. Now, some of that percentage shift is because gold's price has gone up so much.
Right, the value of their existing gold went up.
Correct. But the data confirms they've also been significant, consistent net buyers of new physical gold for years. They are actively accumulating it.
So the policymakers, the central bankers, they're basically anticipating the consequences of their own collective future actions or the consequences of the massive debt loads their governments are carrying.
By stockpiling the one asset that sits completely outside that sovereign debt and fiat currency system, They are hedging against the inevitable endgame of the current path.
And we saw this anticipatory mechanism before, didn't we? You mentioned gold's behavior after its last peak in August 2020.
Yes, after hitting that high, gold didn't crash, but it didn't keep soaring either. It went mostly sideways for almost 4 years, right up until this latest explosion in 2024.
And that sideways period wasn't gold being boring or indecisive.
Not according to this anticipatory framework. That long, flat period from late 2020 into early 2024 was gold anticipating the next phase of policy, the corrective phase,
Which was?
the tightening, the rate hikes. Remember how central banks globally slammed on the brakes? They had to deal with the inflation that their 2020 money printing had unleashed.
Right, the aggressive rate hikes, quantitative tightening, QT, where they started shrinking their balance sheets, that whole painful period.
Exactly. Gold's sideways move anticipated that prolonged global campaign of central bank tightening. It knew the easy money party had consequences, and the hangover, the tightening, was coming.
So gold, once again, proved its predictive power. It topped out in August 2020 before the tightening actually started. It basically signaled the end of the massive expansionary cycle just as the market absorbed the fact that a big, painful policy correction had to happen.
It called the turn on the printing cycle, and then it waited patiently while predicting the necessary policy reaction cycle, the tightening.
That's remarkable. And does this cycle tell us anything about what happens to other assets after gold makes its move? You mentioned commodities earlier.
Yes, that's a really key detail for listeners trying to understand how these things unfold. Historically, what tends to do really well after gold makes a major peak, signaling monetary stress.
Resources, energy.
Exactly.
No.
Resources, energy, industrial commodities. They tend to be the next big beneficiaries in the sequence.
Why the lag? Why don't they move up together with gold?
Think of gold as the purely monetary barometer. It sniffs out the instability in the currency and the debt first. Commodities are more linked to the real-world consequences of that monetary instability.
Ah, okay. So gold signals the money printing is coming or inevitable.
Right. Then, that newly created money eventually starts leaking out into the real economy. It chases goods and services, and crucially, it bids up the price of the raw materials needed to make those goods and run that economy. Copper, oil, lumber, food inputs.
So there's a lag while the monetary inflation translates into actual price inflation in the physical world.
Precisely. And this lag effect is pretty consistent historically.
Can you give a concrete example from that post-2020 period?
Sure. Let's take copper miners. If you look at an ETS tracking copper mining stocks, starting right from when gold peaked in August 2020,
Yeah.
even while gold itself was going sideways for the next couple of years, that copper mining ETF ran up something like an additional 121% from that August 2020 point.
Wow. So gold signaled the underlying monetary problem, went flat, and then the physical resource companies took off as the inflation hit the real economy.
That's the sequence. Gold signals the instability and the coming policy response, printing. Then resource scarcity and commodity price inflation follow as that policy plays out, and money tries to find tangible value.
Okay, this all reinforces the main point then. $4,000 gold isn't some random market fluke. It's deeply connected to central bank actions, anticipating policy, and signaling that monetary policy globally is basically cornered.
Cornered. And that significant, potentially structural inflation isn't just a temporary blip caused by supply chains. It's becoming embedded because of the underlying monetary and debt situation. Gold is screaming that warning.
All right, so if $4,000 gold isn't a classic flight to safety, but it is anticipating these massive policy consequences, what is the ultimate underlying consequence the market is pricing in right now with such an extreme move?
The source material we're drawing from is really blunt about this. It argues gold's current price is anticipating nothing less than a sovereign debt crisis.
A crisis of confidence in governments' ability to pay their debts.
Exactly. A deep structural loss of faith in the solvency of governments worldwide, particularly the major Western ones, drowning in debt.
And the argument is this isn't just appearing out of nowhere, right? It's part of a pattern.
Yes, a very clear escalating cycle of crises. The analysis suggests that each major financial crisis we've lived through has been bigger than the last one.
And the entity that gets stuck cleaning up the mess keeps moving up the chain?
Precisely. The burden of absorbing the consequences, the bomb, if you will, shifts to whoever bailed out the last crisis.
Okay, let's trace that. Walk us through the escalation. Where does it start? 1998.
Good starting point. 1998, the long-term capital management crisis, LTCM. A massively leveraged hedge fund using complex derivatives. It blew up
It
spectacularly.
nearly took the system down with it. Who absorbed that bomb?
The risk was concentrated, but the Fed didn't directly bail them out with public money initially. Instead, they strong-armed the major banks into orchestrating a private sector bailout. The banks had to absorb the hit because their own exposure to LTCM's failure was huge. So bomb absorbed by the banks.
Okay. Fast forward 10 years, 2008, the global financial crisis. Who was at the center of that storm?
The very banks who absorbed the LTCM risk. They'd taken leverage and complex derivatives to a whole new level, especially in housing. This time, they were the weakest link.
And they were too big to fail.
Yeah.
So who absorbed the bomb in 2008?
The burden shifted dramatically upwards. The banks couldn't handle it. So governments stepped in with massive bailouts, fiscal stimulus, debt guarantees, funded ultimately by
Cuss, the taxpayer.
the taxpayers,
Yeah.
through a huge increase in public debt and future liabilities. The debt bomb effectively got transferred from the private financial sector onto the public balance sheet, the sovereign.
Okay, banks absorbed 98, taxpayers absorbed 08. Then we get to 2020. The pandemic hits. Global shutdown, liquidity vanishes.
The entire global economy and the taxpayer base supporting it was suddenly on the brink. What was the solution?
Unprecedented government spending, stimulus checks, business support, combined with central banks printing money like never before, the big print.
And this is the critical turning point. Who absorbed the economic shock, the consequence this time?
The governments themselves, right, by taking on absolutely staggering amounts of new debt.
Yes. The U.S. government and governments everywhere absorbed the bomb directly onto their own balance sheets.
Yeah.
Trillions and trillions in extra debt and extra spending all at once. By using the sovereign itself as the ultimate sponge, policymakers set us on what the source calls an irreversible course of ever-expanding deficits.
And that brings us to today. Gold at $4,000. The sovereign balance sheets are stretched to the limit.
And so now, the analysis argues, we're facing the final stage of this escalating crisis, not just in one country, but a global orchestra, a symphony of sovereign debt crisis threatening to manifest everywhere at once.
And if the crisis is now too big for the banks like 98, and too big for the taxpayers via government borrowing like 08 and 20, who is left to absorb this sovereign debt bomb?
There's only one entity left with a printing press big enough, the central bank itself.
Ah,
Central banks are stockpiling gold because they know, implicitly or explicitly, that they're the ultimate backstop. They will be the ones forced to absorb the losses from systemic failure, likely by effectively underwriting or monetizing their own government's unpayable debts.
okay, so if this sovereign debt crisis is, let's say, baked in the cake, how do governments usually try to get out of such a mess? The sources mention three ways, right? But they're pretty dismissive of two.
Yeah, there are basically three theoretical paths. The first one is the fiscally responsible but politically suicidal path.
Yeah.
Austerity.
Cut spending drastically, balance the budget, pay down debt the hard way.
Sounds great on paper, but the analysis just tosses it out immediately. Why? Political reality. There are simply too many people on the take, meaning too many voters, corporations, and interest groups dependent on government spending.
Any politician trying serious austerity would face massive resistance. They'd be voted out instantly.
Exactly. Too many people would be unhappy.
Yeah.
So austerity, while financially sound, is considered politically impossible in most democracies today. Dead on arrival.
Okay, path one is blocked. What's path two? The hopeful one?
Path two is that we just outgrow the debt. The idea is you have such strong, sustained economic growth that tax revenues rise much faster than the debt is compounding. The debt becomes a smaller percentage of a much bigger economy over time.
This sounds like the preferred narrative of most governments right now. We'll invest our way to growth.
It's certainly the hope. But the sources are skeptical here, too. They argue that many recent policy actions think massive regulations, trade barriers, huge spending programs that arguably misallocate capital have actually been more preventative to outgrowing the debt rather than helpful for it. They're potentially hindering growth, not boosting it enough.
But there is that wild card, right? Technology.
Yeah. Yes, the source does acknowledge one potential game changer.
Yeah.
Future tech breakthroughs. Things like AI, robotics, maybe fusion energy.
Yeah.
These could theoretically unleash a massive productivity boom and rapid growth. But it's potential. It remains yet to be seen. You can't base your survival strategy for a debt crisis today on the hope of a technological miracle tomorrow.
So austerity is politically impossible, outgrowing the debt is uncertain, and maybe being hindered by current policy. That only leaves one door open.
Path number 3. The path of least political resistance. The one gold is screaming about.
Which is?
You just print your way out. Or More accurately, the central bank enables the government to keep spending and rolling over its debt by effectively creating money out of thin air.
How does that work? The central bank buys the government bonds.
Essentially, yes. The central bank steps in, maybe through QE or other mechanisms, allowing the central government to borrow what amounts to free money interest-free debt, or at least debt financed by the entity that can create the currency itself. This allows the government to keep funding its expenses and paying off maturing bonds without having to impose austerity or rely on uncertain growth.
Okay, printing our way out. That phrase scares people. It brings up images of like wheelbarrows full of worthless cash. Weimar Germany, Zimbabwe, hyperinflation. Is that what the source predicts? The US dollar becoming worthless overnight?
No, and this is a really crucial distinction the analysis makes. It argues that while a sudden, complete collapse into US dollar hyperinflation is unlikely,
Okay.
this path of central bank financing of government debt is almost guaranteed to cause a different kind of pain. A prolonged, grinding erosion of purchasing power through three specific, nasty, and enduring consequences.
So not a sudden death, but a slow, chronic illness for the currency. Let's break down those three consequences. These are what $4,000 gold is really pricing in. What's the first one?
First, expect a very long period of much higher inflation than people are used to or currently expecting. This isn't temporary supply chain stuff anymore. This is structural.
Why structural?
Because once the central bank is fundamentally enabling government overspending by creating money, you're permanently increasing the money supply relative to the real goods and services in the economy. That has to lead to persistent inflation. It becomes the new, uncomfortable, high-cost normal.
Okay, so consequence one, sticky high inflation for longer than we think. What's number two?
Number two relates to asset prices. If your cash is constantly losing value due to this inflation, what do people do with their money?
They try to get it out of cash and into stuff, real things, assets.
Exactly. So the second consequence is expect a much higher valuations across almost all asset classes. Stocks, real estate, commodities, precious metals, maybe even crypto. Everything gets bid up.
Not necessarily because the companies are suddenly way more profitable or the house is way nicer.
But because people are scrambling to convert their eroding fiat currency into anything that might hold its value better, it's a flight from currency into assets, causing massive asset price inflation, even if the real economy isn't booming. It's a hedge.
Okay, high inflation, high asset prices. What's the third consequence? This one seems counterintuitive because usually people think printing money means low interest rates forever.
Right, that's the common misconception, but the source argues the opposite. The third consequence is expect much higher interest rates for much longer than most people are expecting.
Higher rates, even with the central bank printing. Why?
Because if inflation is persistently high, lenders and bond investors aren't stupid. They will demand a higher nominal interest rate to compensate them for the purchasing power they're losing every year.
Yeah.
To get a positive real return after inflation, the nominal rate has to be high.
And the central bank will eventually have to accommodate that. They can't keep rates artificially low forever if inflation is raging.
They can try, but doing so would likely accelerate the currency debasement even faster. Eventually, to maintain any semblance of stability or control, they'll likely have to allow rates to reflect the underlying inflationary reality. So yes, paradoxically, the age of printing to solve debt might lead to stubbornly high interest rates alongside high inflation.
So putting it all together, the $4,000 gold price isn't just a number. It's the market screaming that the sovereign debt levels are unsustainable, austerity is off the table, growth alone won't fix it.
Leaving only one path: financing the debt via the printing press, leading inevitably to a long period of high inflation, inflated asset prices, and surprisingly high interest rates. Gold is simply anticipating the inevitable, painful price of that final policy choice. Hashtag conclusion and provocative thought.
Okay, let's try and wrap this up. This deep dive suggests the spectacular rally to $4,000 gold isn't a victory party. It's not a sign of healthy markets or prosperity.
Not at all. It's arguably the clearest warning sign we have. It's validated by the very people who run the system, the central banks buying it for their own reserves. It signals a profound systemic loss of confidence.
Confidence in what specifically?
Confidence in the whole global financial system built on fiat currency and ever-expanding sovereign debt. And it signals the inevitable endgame, that this massive global debt will ultimately be absorbed, paid for through the slow, grinding devaluation of those fiat currencies.
It's the ultimate insider hedge, isn't it? The policymakers are hedging against the outcomes they know are likely given the constraints they face, and the smart money in the market is following their lead.
Exactly. Now, the source does point out that for individuals who understand this dynamic, there are ways to position yourself financially. Owning hard assets, commodities, gold itself, maybe certain equities. You can potentially protect or even grow your wealth in this environment.
But for society as a whole, for the average person,
The outlook presented is, well, not great. It's unlikely to be a period of rapid and well-distributed growth. Quite the opposite, potentially.
because of those consequences we just discussed, the high inflation, the high asset prices.
Precisely. Those things have profound social implications. When inflation is persistently high, who gets hurt the most? People on fixed incomes, retirees, wage earners whose pay doesn't keep up with rising costs.
While people who already own assets, houses, stocks, gold, see their nominal wealth soar.
Correct. So this financial prognosis points directly towards a widening gap. The analysis explicitly suggests that the differences between the haves and have-nots will probably become more extreme.
And that kind of growing inequality, combined with the economic stress of inflation, that sounds like a recipe for social friction, maybe even instability.
That seems to be the implication. The volatility we're seeing in the economy and the markets might just be the leading edge. The structural financial failure that gold is anticipating could easily spill over, creating more volatility in the social and political order as well. The solutions needed to fix the finances might create huge dislocations for ordinary people.
So that leads us to the final provocative thought for you, our listener, to really chew on after this deep dive.
If $4,000 gold is truly the market anticipating this deep structural financial failure, a failure that seems destined to increase economic inequality and likely fuel social volatility, how do you apply that knowledge?
How do you connect the dots between this flashing red light in the gold market and the growing social and economic divides you might be seeing in your own community or reading about globally?
Does the financial instability that gold is signaling perhaps serve as a kind of blueprint or an early warning for increased political and social instability in the years ahead? That's the unsettling question to ponder.
What the sophisticated financial markets anticipate today, the real world, the social world, often experiences with a lag tomorrow. It's a heavy thought to end on.
It is. Thank you for joining us for this deep dive into what $4,000 gold might really be telling us about the future of global finance and maybe society itself.
We really encourage you to keep thinking about these connections, looking beyond the day-to-day market noise to the deeper systemic signals.
Keep digging, keep questioning the easy narratives. There's a lot at stake.
Until next time.